But remember, it is kind of unproven.
Yeah, well, but, this is why we love, hate, respect, revere, Elon Musk, is that he goes to these places and just thinks differently. And he certainly catches our attention. Looking forward, Ed, to finding out what car you are driving and also to hear more of your reporting about Elon Musk and his event tonight on SpaceX. Our Ed Ludlow, West Coast correspondent at Bloomberg News, normally on the West Coast, but in Texas on this Thursday.
Well, let's head from Texas to Washington, D.C. We're going to check in with Nancy Lyons. She's got the latest on world and national news. Hey, Nance.
Hey, Tim. The nation is seeing the hottest inflation since 1982, with consumer prices jumping in January 7.5% from a year earlier. Bloomberg's Irv Chapman has more on today's report from the Labor Department.
Prices continue to rise because consumers continue to buy goods in short supply rather than going out for meals, entertainment, or travel, Chief U.S. economist Tom Porcelli of RBC Capital Markets said in a Bloomberg interview.
For the next few months, we'll see continued upward pressure from goods. I think what's going to wind up happening this year is that this transition is going to happen from people basically spending a lot on goods and shifting to services. And I think goods prices could actually start the process of slowing pretty meaningfully.
Porcelli summed up that inflation will get a bit worse, but by the end of the year, quite a lot better. In Washington, Irv Chapman, Bloomberg Radio.
The House Oversight Committee has opened an investigation into former President Trump's handling of official records. That's after the National Archives came away with 15 boxes of documents from the former president's resort in Mar-a-Lago. The Archives has reportedly asked the Justice Department to look into whether any of it may be classified. We get more from Bloomberg Government's Jack Fitzpatrick.
Some feedback from the Justice Department was this could be handled by the Inspector General for the National Archives. So it's unclear exactly how much this heats up, but clearly quite a bit of back and forth on what appears to be potentially some improper handling of documents on the former president's way out.
BGov's Jack Fitzpatrick. The New York Times today is reporting there are also gaps in White House logs of President Trump's phone calls on January 6th. Global news 24 hours a day, on air and on Bloomberg Quick Take. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Master, Tim Stanovic. We are live in the LA Bureau of Bloomberg News. And you got an ACN phone?
I don't, I don't have an ACN phone. I actually didn't know about former President Trump's foray into video phones before reading this story by Eric Larson, which is among the most read on the Bloomberg terminal.
Yeah, it was pitched as revolutionary, a desktop video phone that would modernize phone calls from the C-suite to the kitchen counter. And starting around 2008, the future U.S. president, so we're talking about Donald Trump, endorsed the device sold by a multi-level marketing firm called ACN Opportunity, with claims that people could make easy money peddling it, quote, without any of the risks most entrepreneurs have to take. And the former president saying, and at that time he wasn't president, trust me, it's changing everything.
The former president was paid nearly $9 million to promote ACN products between 2005 and 2015, said in a promotional video, trust me, it's changing everything, as you mentioned, Carol. He continued, the absolute truth is that this technology will be present in every home within the next several years. He could have been talking about the iPhone.
Yeah, he could have been, but he wasn't. And needless to say, those promises or those endorsements didn't exactly work out the way he said. We know Skype was gaining ground, video calling became ubiquitous on smartphones, hence what Tim was just talking about. And in 2018, 4 recruits who lost thousands of dollars trying to sell the company's products filed a class action fraud suit against Donald Trump and 3 of his adult children who also promoted ACN. We're talking about Donald Jr., Eric, and Ivanka Trump.
The Trumps deny the claims. They face, though, a June 29th deadline to sit for depositions. The plaintiffs believe that they can prove that the Trumps lied about their faith in ACN's products and exploited vulnerable investors for profit without disclosing that they were being paid to promote the company.
Well, and this is, it's interesting. I don't know what the responsibility is, right? Like you think about celebrity endorsements or, what is the ultimate responsibility in terms of what they're saying and what they're promoting?
What makes me think of all the crypto promotion that we're seeing from celebrities right now, and likely we're going to see this weekend with the advertising around the big game.
That's a really good point. All right, certainly we'll be following this one and see how that case plays out.
headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We are off session lows, still a down day across the board. The Dow, the S&P, and NASDAQ all extending declines after Federal Reserve Bank of St. Louis President Jim Bullard said he supported raising rates by a full percentage point by July. S&P now lower by 62, a drop of 1.4%. The Dow's down 419, down 1.2%. NASDAQ down 207, a drop there of 1.4%. 10-year yield 2.02%. Yields on 10-year Treasury notes rising above 2%, highest since 2019. We've got gold down 0.2%, falling $2.73 the ounce to $18.30, and West Texas Intermediate crude oil up 0.1%, $89.77 a barrel. Bitcoin up now by 0.6%, 44,770. After earnings, the Walt Disney Company up by 4.2%. Among some of the names reporting after the bell today, we'll be hearing from Expedia Group. Those shares up by 0.4%. And Zillow flat on the day right now at $49.62. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, in the new issue of Bloomberg Business Week, an update on a story about the loan shark, then President Trump, freed from prison, who is now lending money again. It's a story that Zeke Fox of Bloomberg has been following for some time, Tim.
Zeke Fox is financial investigations reporter. He joins us in the Bloomberg Interactive Broker studio. Joel Weber is editor at Bloomberg Business Week. He joins us as well from the Bloomberg Interactive Broker studio. Joel, before we get into the pardon, the sentence that wasn't served, remind us, who is Jonathan Braun?
Jonathan Braun is the story that Zeke writes is basically the main character in that. He also was a prominent character in some previous reporting that Zeke and our colleague Zach Miter did for the magazine a couple of years ago that kicked off really with a Business Week cover story called Sign Here to Lose Everything. That became a series of stories. Braun figured into some of those and ended up going to jail, although not for predatory lending. It was actually on some drug charges. But you're right, on the last day of President Trump's presidency, he commuted the sentence. And John Brown, as he is about to tell us, sometimes you do what you do best. And he's back to doing a certain kind of business. What'd you find, Zeke? And how did the story come to you? Because for the record, by the way, guys, this story is unbelievable.
Thanks, Joel. Yeah, I mean, a few months after John Braun got out of prison, I started getting calls, late night texts. People are saying John Braun is back in business. And this is a big deal because he's famous in this world of merchant cash advance, which are guys who lend money to small businesses like truckers, restaurateurs, cleaners, anyone who's got a little company. They borrow money at these crazy interest rates. And even among people who charge 1,000% themselves, they're coming to me and saying, this guy, John, is ripping people off. How did he get out of prison? How did he get a pardon from Trump? And then they started tipping me off and saying he's got a new operation based in Borough Park. And he's famous for just like vulgar rants. We have a video of one that you can see if you read the story where he's threatening borrowers, he's cursing them out. And then he's very smart, and he invents these uses these legal loopholes to seize people's money when they fall behind on the loans, which is quite common given that the rates are so high. You borrow 10 grand and you might owe 20, in a month or two.
Yeah, talk to us about that, because the victims in these stories, and you have a couple examples in the story. What do they go through when they enter into an agreement?
Yeah, so I spoke to one guy, Brian Massey. He was a mechanic in Memphis, and he's having a tough time with his business with the pandemic, and he started. You never just take one of these loans. You turn to one of these. Somebody calls you, salesman, and says, "Hey, do you need any money for your business?" And Brian did, and they say, "We're going to get you a great loan, but first maybe take this trial deal." And, you're going to get 20 grand, and don't worry about it. Like, it's going to be a good rate. And so he when the contract, these are all done, this isn't like your loan shark on the corner. These people are signing contracts, and when the contract says, hey, you'll get 10 grand and you have to pay back 15 in 45 days or something like that. So the contract, you're agreeing to something that's got pretty tough terms, but then on top of that, there are all sorts of hidden fees. There's really punitive terms if you ever fall behind and they have to collect on you. And according to these borrowers I interviewed, these lenders don't always live up to their end of the contract. Will sometimes take extra fees or start trying to sue someone for defaulting when they have barely fallen behind or haven't fallen behind at all. So it can be really devastating for these businesses. Massey, the mechanic, by the time I was done reporting the story, he had to close his shop and take a job as a security guard.
Wow.
But meanwhile, it can be very lucrative for the lenders, as you can imagine, if you're lending at 2,000% a year.
Hey, Zeke, can you spent some time with Braun over the years. Explain his personality. We have examples of him lashing out at clients, but you spent hours with him.
Actually, Tim didn't say it correctly. Inspector Gadget, we'd like to have you explain. And you don't have to explain that one. People have to go read the story to know that one.
Well, yeah, so when I was investigating this loophole a few years ago, he was one of the biggest users of it, or abusers of it, according to the people I spoke to. It's called Confessions of Judgment. He wouldn't take my calls, so I stopped by his office and spoke to him for quite a bit. And first, he was very angry and berated me in front of everyone. But then, I wasn't. That's what I'd heard he would be like. But once he invited me, he said he needed to calm down. He invited me up to the roof so he could have a cigarette. I said, let's go to the street instead. So we hung out on on the sidewalk in the financial district, and he says your sources are wrong. They're making all this stuff up. Why are you out to get me? You're harassing me. But yeah, he's not a pleasant person.
He also offered you a job.
I'm not sure if it was like a real offer, but at some point he said something, it's more like, we're not so different, you and I. Like, here you are harassing me, what do I have to do to collect debts? Like, why are you blaming me for calling borrowers when you're very aggressive yourself?
Well, he uses profanity and calls you Inspector Gadget. Like I said, people have to read the story. We only have like 40 seconds left here. Just quickly, how was he pardoned?
That's the crazy thing. He's telling people, like I've spoken to people who've spoken to him, he's bragging that it cost millions of dollars that he paid to, various Trump-connected people. But the only thing I could nail down is that he did, and I don't know if Dershowitz says it didn't cost anything, but he did get Alan Dershowitz, the lawyer for Trump in his first impeachment, to represent him, to advocate for him. Dershowitz says, he got only a small fee, but he can't remember exactly how much. But it could be that Braun had other people advocating for him too. I just couldn't get to the bottom of that part.
We know that there'll be more installments, and we're going to look forward to reading them. Zeke, thank you so much. Zeke Fox, he's financial investigations reporter at Bloomberg, back in our interactive studio, along with the editor of Business Week, Jill Weber. This update in the new issue of Business Week.
February is Black History Month, and every day this month we are celebrating significant moments in U.S. Black history. Now, with your installment for February 10th, here's Bloomberg's Renita Young.
On this day in Black history in 1989, attorney Ron Brown becomes the first African-American elected national chairman of the Democratic Party. As chairman, Brown played a key role in securing the 1992 election of Bill Clinton, who was the first Democrat to win the U.S. presidency since Jimmy Carter in 1976. So in 1993, Clinton nominated Brown as Commerce Secretary. And when the Senate confirmed him, Brown became the first Black person to hold that cabinet post in U.S. history. That's Today in Black History. I'm Renita Young, Bloomberg Radio.
Big thank you to Bloomberg's Renita Young for Today in Black History.
All right, right now markets hovering near their lows. We'll get an update on trading in just a moment. This is Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We move into the final hour of trading on this Thursday, February 10th. It is a down day with the Dow, the S&P, and NASDAQ all declining. In fact, we are at or near session lows. Right to the numbers. We'll give you the why in a moment now with the S&P down 76 points. That is a drop of 1.7%. The Dow extending its loss now to 521, a drop of 1.5%. NASDAQ is down 273, a decline of 1.9%. 10-year yield right now, 2.02%. Yields on the 10-year rising above 2%, the highest since 2019. And we have got gold down 0.2%, $18.29 the ounce. West Texas Intermediate crude up 0.3, $89.92 a barrel. Bitcoin down 0.3%, 44,363. Stocks extending declines after Federal Reserve Bank of St. Louis President Jim Bullard said he supports raising rates by a full percentage point by July. PepsiCo has delivered a full-year sales outlook ahead of estimates as the company raises prices on salty snacks and bottled beverages, given robust demand. Hugh Johnson is PepsiCo's CFO. He spoke this morning with Bloomberg Television and Radio.
Right now, the consumer is very much responding to the investments we've made in brands, the investments we've made in product development and innovation, and they're coming to our products. We're gaining market share in most of our markets in both snack foods and in beverages. And what you saw for the quarter was a 13% revenue increase in convenient foods and an 11% increase in our beverage business.
And right now, PepsiCo shares, they are trading lower. PepsiCo is down by 2.1%. Also reporting earnings this morning, the Coca-Cola Company higher by 0.7%. After earnings, Canada Goose plunging now by 16%. Recapping 10-year yield 2.03%. S&P down 1.8%. I'm Charlie Pellet. That's a Bloomberg Business Flash.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, so you guys know we're on the West Coast because we're doing a lead-up event, Bloomberg Live event, Power Player Summit. That's tomorrow in Beverly Hills. We're going to be talking to all types of individuals who are involved in the sports world. You know the big game, of course. It's about so much team. It is about so much Tim.
And teams as well.
Teams, players, coaches. There's also a lot of technology involved.
There is technology from many different companies. One of those is Samsung. Mark Kiroys is Vice President of Marketing for the Display Vision for Samsung. Joins us right now on the phone from Los Angeles. Mark Kiroys, how are you?
I'm good. How are you all doing?
We're doing well, thanks. Hey, give us an idea of what people who are going to be at the game on Sunday are going to experience from a technological point of view. I mean, beyond looking at their smartphones, beyond being able to communicate with one another, beyond being able to communicate with others, what tech are they going to be immersed in?
Sure. So it really starts when the kind of fans even enter the venue, right? They're going to start to interact with a lot of display technology that the stadium and the venue have put in place, that Samsung technology. And when they finally get the opportunity to see the playing field above it, they will see the Infinity screen by Samsung, right? So that is that's the video board that sits about 120 feet above the playing surface. And it is an awe-inspiring technology, right? But that's not all. They'll see all of the different LED screens across the whole venue. And what's really interesting is that my first experience earlier this season when I visited the venue, it was a bit of an awe-inspiring experience. But what really got me was that I would tend to look at fans during the game, and they were so immersed in the technology and the screen above the action on the field that I caught them a lot of times watching the screen versus the actual action on the field. So it's pretty amazing technology.
Well, you think about it, Mark, and you think about this new incredible SoFi Stadium, right, that the game is going to be played in. But you're right, I feel like big screens were like one end or at each of the, end zones. But this is just, as you said, it's a circle, of all LED light. Like you can just be looking at things from, anybody can see something that's up there. The experience of the game, I feel like technology, or the experience of sports generally, technology plays a bigger role. I think about being, at the U.S. Open in Forest Hills, and you're watching the speed of the balls. And like, it's just become such a much more high-tech experience.
Oh, absolutely, right. The enhancement of the experience is continually being raised, right? And I think that's where technology plays a key role to continue to create that fan experience, that guest experience, because you're competing against, the technology in the home, right? I mean, the technology in the home has gotten very good. If you own a Samsung TV, right, it's great technology. You got great viewing of whatever action that's there. So you have to enhance that. That experience has to be even better to entice fans to keep coming into those live venues. And that's what we've done here with the Infinity Screen in partnership with the venue to deliver that one-of-kind experience, and then being able to augment that with analytics and other information so that you get those heads looking up and off of those screens on their phones, right?
Right, and then you throw in audio, right? Isn't there something like 260 JBL by Harman speakers? I mean, I can just imagine like it's a home theater system on steroids.
Oh, absolutely. And when you have the visuals combined with the audio, they're in my experience this past season, and I'm sure that the big game will have even more unique content that they're going to deliver when it comes to pass on this weekend. But they would use that content because the Infinity Screen is basically a blank canvas. It gives the operators the ability to do whatever they want in trying to communicate to their fans. And so there were sequences of content that they would really pump up the crowd, and then with those visuals, and then bring in the sound system to the point where, it became almost deafening.
Yeah.
Right. Hey, we're talking with Mark Quiros, Vice President of Marketing for the Display Division at Samsung. Mark, you are Vice President of Marketing, so help draw the line here from a really expensive investment like this at the stadium to getting people to go and buy Samsung displays for their homes.
Yeah, so I think, the key is you're trying to deliver one-of-a-kind experiences, whether that's in the stadium or even at home, right? So, the technology itself, what you'll see on display if you have the privilege of being in the game or at the game on Sunday, is some state-of-the-art technology, including our HDR10 Plus technology, that you'll have the same thing in that home viewing experience, right? So that's really enhancing the contrast, the light and darks to expose those fine image details, right. And never miss a minute of the action.
Hey, Mark, what's the demand? A lot of people are redoing stadiums. We're all talking about, especially post-pandemic, experiencing things, and I feel like there's a lot more entertainment venues. What's the demand for your services, you guys at Samsung, to build something like this or similar scale type things when it comes to boards? And just got about 40 seconds.
Yeah, sure. No, the demand is very strong, right? We were coming out of this pandemic situation. Everyone is looking to deliver a unique experience. And so, we've been able to build off of key stadiums like Chase Center, where the Golden State Warriors play, to now SoFi, to then our next one that's coming up during the next Major League Baseball season with the New York Mets, which is Citi Field. So we have a lot of opportunity in the future.
How do you watch the game? Or how will you watch the big game? Will you be here?
How will I watch the game? Very closely, given that my two favorite teams will be playing on Sunday, the Rams and Samsung.
Oh, no, I heard that. I'm not going to take offense to that as a Bengals fan, okay? The Rams and Samsung. All right. Are you going to be there, though?
Yeah, that is to be determined, right?
Okay.
I love to be in the stadium, but I also love watching at home, so I'm a little torn.
I get you.
Wow.
I'm with you. It's a lot of fun. Good luck to both teams. All right, Mark Quiros, VP of Marketing for the Display Division over at Samsung, on the phone from LA.
Let's get a check on the latest world and national news with Nancy Lyons in the 99.1 newsroom in D.C. Hey, Nance.
Thanks, Tim. President Biden says it is time for lawmakers to step up and pass his plan to lower prescription drug prices. He says Americans pay way more than those in other countries, and he says drug companies need to realign their pricing models.
Let's add up how much, and like they do in Germany, how much did it cost you, all the research and development, all the effort, add it all up, and then on top of that, add a significant premium for it, a profit of 20 to 30% above that.
Biden says his plan would impose a steep tax on companies that charge way above what a drug costs to make. The latest read on inflation shows a 7.5% jump year-over-year, and it's prompting Democratic Senator Joe Manchin to throw even more cold water on President Biden's economic agenda. Bloomberg's Nathan Hager reports.
The moderate from West Virginia put out a statement saying it's beyond time for the Federal Reserve to tackle inflation head-on. He says Congress and the administration, quote, must proceed with caution before adding more fuel to an economy already on fire. Consumer prices rose last month by 7.5%, the biggest year-over-year increase since 1982. In recent days, Manchin has declared President Biden's Build Back Better agenda dead. He says he hasn't been part of any formal negotiations to revive the package at this point. In Washington, I'm Nathan Hager, Bloomberg Radio.
Congress has given final approval to legislation guaranteeing people who experience sexual harassment at work can seek recourse in the courts. It bars employment contracts from forcing people to settle cases through arbitration. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Carol Master, Tim Stenovic, we are live at Bloomberg's LA Bureau, and say it isn't so, Tim.
Well, you know, we hear a lot about supply crunch, right? When it comes to supply chains, we talk about chips, we talk about container shortages, and you know what, Carol? Something that there is also a supply chain challenge with is chicken wings.
This is not good ahead of the
Connection
Super Bowl. There's
lost.
a crunch on chicken wings coming ahead of the big game Sunday that has the finger food favorites near an all-time high when it comes to pricing for the time of the year.
All right, it's going to cost you, but check out these numbers. Americans are projected to eat massive amounts of the game day snack, about 1.42 billion wings. Does that mean, Carol, does that mean that's that many chickens, or are there several wings per?
Well,
I mean, I know there are two
do you
chicken.
cut it in half and then it's that many chickens?
And sometimes it's a drumstick. So you could have, like,
Good
one thing I don't know
point.
is how many wings are provided by one chicken. Maybe I don't want to think about it.
Let's not think about that. I like to think, I don't know. I like to be a little disconnected from my food. Anyway, that 1.42 billion wings that Americans are expected to eat ahead of the big game, tied with last year for a record. This year, though, there are signs that getting those volumes to consumers is harder. Supplies are tighter. Add to that the turmoil that has been dogging U.S. food supply chains, from labor shortfalls to missing ingredients and soaring costs all around. It's not looking good.
No, restaurants are scrambling. Some are getting ready to switch to frozen wings in case they run out of fresh. Others are reducing the number of wings that come in an order. That's an inflationary sign, too. And a sign of the times, companies like the one that owns Chili's, they are booking their chicken orders into the summer and beyond to lay claim to whatever's available.
All right, so in terms of pricing, currently they're $2.61 a pound wholesale, which compares to a 5-year average price of around $1.76 before the pandemic.
An unprecedented surge in chicken popularity is really at the root of wing inflation. Nearly all types of restaurants have seen a drop in locations over the past 4 years, except one called Southern, and that's because the category includes fried chicken joints like KFC, Popeyes, Bojangles, and Raising Cane's.
It's really, I know we're having some fun with this, but a sign of the times, right? It's just that those supply chains just really having a difficult moment. This is Bloomberg.
hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. It is a down Thursday with the Dow, the S&P, NASDAQ. They are all declining right now. We have got the S&P down by 1.5%. Let's head right over to the first word breaking news desk for today's afternoon call. Here's Bill Maloney.
And good afternoon, Charlie. U.S. stocks plunge intraday as Bullard favors the first half-point U.S. rate increase since 2000. Dow's currently down 456 points. S&P's dropped 70, while the NASDAQ is lower by 246. The U.S. 10-year jumps to 2.03%. Gold is down 4, oil trading higher, and Bitcoin is little changed. Among the main 11 S&P sectors, all are in the red, led by losses in real estate, utilities, and tech. Leaders to the upside in the Dow, Disney, and Boeing, while Amgen and Microsoft led to the downside. In other news, Fed's Bullard favors a 100 basis point interest rate increase by July 1st. After earnings, Pepsi fell 2.7%, Uber dropped 4.9%, and Affirm Holdings plunged as much as 33%. Wrapping things up, Expedia, Zillow, and Yelp all report after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill. And to hear live breaking news on your Bloomberg-type squawk, SQUAWK on your terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Tim and I are talking toys. Thanks so much, Charlie. Well, we are going to talk toys because it's all fun and games today when you check out shares of Mattel stock soaring after the company reported fourth quarter profit and sales that exceeded analyst estimates, buoyed by revenue from traditional toy brands. We're talking Barbie and Polly Pocket. So great to have back with us the Mattel CEO.
We're talking Ynon Kreiz, Chairman and CEO of Mattel, joining us on the phone from California. Ynon, it is really great to have you back with us.
We're in your neighborhood,
Yeah,
actually.
we are. We could be doing this in person in another world, right? Ynon, what worked so well for Mattel this in the holiday quarter?
Well, hi, Tim. Hi, Carol. Yes, this was just an exceptional quarter and year for Mattel. We outpaced the industry. We gained share globally for the second year in a row and in every measured market. We also had the highest annual growth rate in decades, double free cash flow, and more than double our earnings per share. So the way we see it is that our turnaround is complete, and Mattel is in growth mode. The strength is broad-based. We expect to continue to gain market share with strong growth in 22 and in 2023, and are not stopping there.
All right, so many questions we want to ask you. First of all, I know we remembered when we talked with you last time, and that was leading up to prior to the holiday shopping season, and we talked about supply chain constraints, and you said you were working through them. You were figuring them out. I think you ordered a lot of inventory in advance. How are the supply chains today?
That's right. We did exactly that. We did work and navigate through supply chain issues, and it's not that there were no issues, but this is our job. This is what we do.
But how did you do it? Because so many other people, and of course, different industries are not apples to apples, but how did you do it? How did you manage the supply chain challenges?
Well, we anticipated the short supply and the longer lead times and factored that into our planning. We took very specific actions. We pulled forward production to increase capacity. We expedited procurement and sourcing of raw materials. We optimized near-shoring of production. We contracted ocean freight capacity and rates in advance, and also secured access to additional ports and shipping lanes. All these things were designed to mitigate for the disruption. And this is exactly where our restructured supply chain that gives us, that is more flexible, more capital light, is able to withstand and respond to this type of situations.
What are you seeing right now in the supply chain? How are you planning for 2022 to make sure to mitigate whatever you can when it comes to these challenges continuing?
Well, we still see some challenges, but this is something that we have been working through during, over the last 2 years. And even with that, we saw 18% of growth for the year, and still planning for growth in 2022. Strong growth for 2022. We expect growth for all of our power brands, Barbie, Hot Wheels, Fisher-Price, also for American Girl, and see continuing demand for our product.
Hey, how did American Girl? Because I felt like I have to say, I have a daughter. She's now 18. But man, my house was full of American Girl stuff, a lot. And we were all in. But then it seemed to have, a tougher time, and it feels like you guys have scaled back a little bit. How have you kind of reinvigorated that brand again?
That's right. American Girl went through a turnaround. It's now growing. It grew for the full year. It's having really strong momentum with positive results across all key metrics, as well as our direct-to-consumer strategy. It improved profitability. It grew with new customer activations, average order value, conversion rates, and most of the work has been around leveraging what made that brand successful in the beginning: the quality, the deep engagement with consumers, having a very robust digital flagship with deep engagement for our D2C offering, and a lot of investment in innovation and content that accompanied the physical product. So American Girl is back. It's seeing really exciting momentum, and we expect it to grow for the full year.
Hey, Ynon, you and I last connected just a few months ago on Bloomberg Quick Take, and you were joining us from the White House because you had just met with President Biden and his team to work on supply chain issues. Here we are a few months later. We still see inflation very, very hot, 7.5% CPI print this morning, hotter than analysts expected. Thinking back to that meeting and where we are now, did anything material come of that meeting at the White House?
Yes, I would say that we have seen improvement in supply chain, especially clearing access to ports where there were some issues. Now, much better flow of product into the country. And, inflation is obviously, this is something that is a global situation. And we are navigating through it and taking actions to mitigate for it. And believe we're in a good place to continue to grow our business and improve profitability in spite of inflation.
So do you feel like we are in a better place as a country when it comes to supply chains, when it comes to log jams at our shipping ports than we were back in late November, early December?
We have seen improvement, and I believe that the system is now able to manage through those issues. It's not that we're completely out of the woods. We still expect issues, but at the same time, people at this point became much more ready and able to respond to these situations.
When you're planning for this year and next year, at what point do things go back to normal for the supply chain for Mattel?
Well, with every day that goes by, we believe the situation is improving. We also see it with inflation. We expect to have lesser inflation in the second half of the year, and for inflation to moderate in 2023. So gradually, we believe that things will come back to normal. We see it also with the COVID impact. And if you look at what happens in other countries, gradually, it feels like we're coming back to normal. Now, we always have to be alert and aware and make sure that people around us are protected and we, in terms of health and safety. That said, we do see an improvement, a gradual improvement, and particularly with inflation, we do expect things to improve. And all of it, obviously, to be clear, is factored into our planning. We are expect certain challenges, but already took account for that.
Well, that's what I wanted to ask you, Ynon, because you have an investor event next week, and I'm reading a lot of the analyst commentary following your earnings, and one of them saying, talking about confident and robust, your outlooks for 2022 and 2023, but one saying, I think KeyBank, that they almost felt like you gave too strong of an outlook. What do you have to do next week with investors who are now very upbeat and expect a lot from you? What do you have to manage in terms of expectations? Because not everything, as you know, always goes as planned or as forecast.
That's right. We obviously developed for 2022 a pretty robust plan, bottoms up. We do expect to see growth in our litter categories, in dolls, vehicles, and infant, toddler, preschool. This is, again, an area where we a global leader, and we have very strong foundation. We expect our challenger categories as a whole to grow, led by action figures, where we about to have very strong theatrical lineup with Jurassic World, with Minions, Disney Lightyear. So, you know, it is broad-based. We're not relying on one property or one category or one power brand. We see strength across the portfolio. We are seeing demand at levels we have not seen in years. And if you look at our trajectory and what we've achieved over the last 4 years, you know, the numbers speak for themselves. Now, that said, I want to be clear that we're not sitting here and expect this to be an easy journey. We will work hard, and the organization is ready to take on the challenge.
Well, the stock hitting a 52-week high today. It's up almost 14% so far this year, and of course getting a big boost because of the jump in today's share. I have to ask you, Tim and I are on the West Coast, lead up to the Super Bowl, a big Bloomberg event called the Power Player Summit tomorrow. We're talking with all people that are involved in the world of sports, and I'm going to catch up with Stephanie McMahon over at WWE. I mean, you guys have a partnership with them. I'm looking at, you know, your website, these action figures, you know, whether it's Damian Priest or Drew McIntyre. I mean, these kind of relationships, you guys really cast a fairly wide net when it comes to products.
That's right. We're very proud of our relationship with WWE. It's been a great relationship. And overall, we are looking to position Mattel as a partner of choice for the major entertainment companies. We are focused on market-moving franchises, big, important, culturally relevant brands, and are doing a great job at that. And of course, the latest win for Mattel in this area is the addition of Disney Princess and Frozen franchises to our portfolio. This is something that we just announced recently. This is another important addition to our portfolio.
Hey, love Frozen.
Enon, we only have 20 seconds left with you. The new Barbie movie, Ryan Gosling, Margot Robbie, how big is that going to be for you?
We couldn't be more excited. It's a great cast. Greta Gerwig is writing, and she will direct it in partnership with Warner Brothers. Can't wait to get it out.
So cool. Always fun. You always give us lots of time, and we really appreciate it. We get to really dig into your business. Enon, thank you so much. Mattel CEO Ynon Kreiz on the phone in California, and as we mentioned, definitely one of the standouts in today's session, considering it's a downward market. That stock up 7.5%.
Well, you mentioned the downward market. Mattel shares higher. Let's get an update on all things happening in the markets right now. Here's Charlie Pellet.
Hi, thank you very much. Just about the low of the day. That's what's happening right now. Tim Stenovic, 29 minutes to go ahead of the closing bell. Right to the numbers. We'll give you the why here. S&P down 80, drop there of 1.8%. The Dow down 527 now, drop there of 1.5%. NASDAQ lower by 287, tumbling now by 2%. 10-year yield, 2.03%. Yield on the 10-year rising above 2%, the highest since 2019. Stocks extending their declines after Federal Reserve Bank of St. Louis President Jim Bullard said he supports raising rates by a full percentage point by July. Again, the 10-year yield, 2.03%. Spot gold down 0.3%, $18.29 the ounce. And West Texas Intermediate crude is up 0.5%, $90.08 a barrel. Again, though, the S&P down by 80 points, a drop right now of 1.8%. Protesters against France's vaccine mandates aim to use their vehicles to block roads in Paris beginning tomorrow as support for the freedom convoys that first began in Canada spread to other countries. In the United Kingdom, Prince Charles has tested positive for a second time and is self-isolating. Dr. Chris Beyer is a professor of epidemiology at the Johns Hopkins Bloomberg School of Public Health, and on Bloomberg Surveillance this morning, he was asked for an update on vaccines that will guard against the latest COVID variants.
Well, there's obviously a great deal of work underway on that front. People have been working on a pan-coronavirus vaccine. Both Pfizer and Moderna are working on Omicron-specific vaccines. So that is absolutely happening. I think the challenge that we're still seeing is that there's a lot of breakthrough infections, even in fully vaccinated people with Omicron. That's part of why it's spreading so effectively, as we all know.
Dr. Byer with the Johns Hopkins Bloomberg School of Public Health, which is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Checking those vaccine stocks, Pfizer down 1.7%. Its German partner BioNTech down 3%. AstraZeneca up 2.2%. Moderna lower now by 2.3%. Johnson & Johnson down by 1.1%. Recapping 10-year yield right now 2.03%. S&P down 85, down 1.9%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Well, as we do each and every day at this time, we turn now to Bloomberg Markets correspondent Kriti Gupta, who joins us live from the Bloomberg Interactive Brokers studio with her chart of the day. Sign up for Kriti's chart of the day. You can do that at kgupta129 at bloomberg.net. Also check out her Twitter and Instagram at Kriti Gupta News. Kriti, today it's all about bonds.
It is all about bonds. It's been a really wonky day in the markets, but in the bond market in particular, we had the 10-year yield come back above 2%. So for my chart of the day, I decided to look at this into some historical context that basically illustrates the 10-year yield going all the way back to the 1980s. And we do it, of course, on the Tom Keene log scale to show just how deep and how wide the moves have been over the years. And if you actually look at the trend line going all the way back to the 80s, well, it tells you one thing. The yield has continued to drop even from 40 years ago. It just seems a very steady downtrend. What that really signals here is that despite all of these kind of, I want to say market mania, that yields are continuing to rise, that inflation is running away, well, compared to the long-term trend, and we're actually still below it. So we haven't actually hit that longer-term trend yet. So for the folks who've said, well, you know what, I'm just never going to make money on a bond again. My investments in my bonds are completely going out the window. Well, hold on to your horses because that could very easily turn around. At least that's what history suggests.
Yeah, it's an interesting trend line, right? We have just been in such a low-rate environment for so long that you forget it wasn't always this way. And it's been very difficult, right? There is no alternative. It's why so many people have plowed into the equity side of things or other alternative investments because you just couldn't find it, certainly, in the fixed income market.
Yeah, and I think this is what's really important. I mean, this is what, Carol, you always ask me, like, why should people care? Why should someone who's not in finance give a crap about essentially these kind of charts? But I think for bonds, this is really important because a lot of people's pensions accounts aren't just exposed to the S&P 500. They're also exposed, to the bond market. And to your point, Carol, you've seen a lot of investors in the market go to stocks and pull away from bonds for exactly that reason, that there's no return, that there's no yield. But if you go and look at some of these funds that have been around for ages, well, they have actually been performing fairly well. So it tells you once again that if you're in it for the long haul, then bonds have actually proven to be a decent investment.
That's so interesting because as Carol mentioned, there is no alternative. We hear so often from asset managers on our program who are going all in on equities, at least for the short term, because of what we've seen when it comes to fixed income. So, look, you're not giving investment advice, obviously, but what do the data say about having a fixed income portion in a portfolio over the long term?
Yeah, so of course not investment advice, but historically, like I said, I mean, bonds have actually, we always haven't been in this kind of negative yield environment. Bonds have actually proven to give returns, and that's why you continue to see treasuries come back and back, not the yield, but the actual treasury contracts. People continue to buy into them. And the reason we see yields continue to drop, well, it comes down to the economy, right? At the end of the day, the U.S. is not the same economy it was 40 years ago, and that makes that kind of uncertainty kind of pull a little bit more money into the bond market, among other reasons. There's demographics, there's kind of a change in how the U.S. economy functions. I can go on to all those details, but for now, what you really need to know is that just because you see yields continue to rise, that doesn't mean bonds are dead forever.
All right. Well, there's a bunch of investors out there, especially older investors. You're probably like, thank God. It's good to hear that. What else is on your radar today?
Yeah, well, let's just talk about earnings, right? They're coming in hot and heavy, and I like to look at one of my favorite companies here, which is PepsiCo.
Is that because you're from Texas?
Everyone asks me that. No, I'm a Coke girl, but, whatever.
Oh. Interesting. I didn't know that. Well, you got to have a reason why it's one of your favorite companies, right?
Well, it's one of my favorite
PepsiCo's
companies.
New
Back in college.
Frito-Lay, PepsiCo.
Yeah, but it's New York.
Well, back in college, I pitched PepsiCo to one of my stock investments as a college competition, so that's why it's one of my favorites. I lost, but it was still, it holds a special place in my heart. But basically the story here is that they're actually coming up with a bigger price increases. They're trying to meet those margins, offset some of those commodity costs, not only in their kind of sodas, but in their food products as well. And right now, they're really struggling to do that. Their margins, actually, their lowest in over 20 years.
Okay, hey, I have to correct myself. I should know this because my dad years ago worked at Pepsi, and he worked, years ago. The headquarters are in Purchase, New York, so it's a New York company. What I was thinking about, Creedy, because you're a Texan, I was thinking about Frito-Lay, which of course Pepsi owns, and I'm sure we'll see a lot of ads for it this weekend. That's based in Texas, so forgive me.
That's all right. I forgive you. But yeah, there's this ongoing debate about whether what's the best soda is, right? Coca-Cola, Pepsi, or Dr. Pepper. When I moved from Texas to Virginia and I started drinking Dr. Pepper, everyone looked at me like I was from another planet. And I think that's a Texan thing, maybe.
Okay.
It's my husband's favorite drink, and he's kind of lived all over the country. But yeah, that's interesting.
Whoa. Oh, you know what? Creedy, it sounds like you're at home actually with the pup.
I am at home with the pup. I'm so sorry.
Give it away.
He just wants to get in on some of the radio action.
Hey, listen, final thoughts. We got you 30 seconds markets today. Who knows what will happen tomorrow, whether investors settle down and understand that we know the Fed was going to start raising rates. It also means there's economic growth. Just look at some of the earnings that we got late yesterday.
Yeah, I mean, I think one of the big questions when it comes to the entire stock market right now is 50 basis points on the table. And the comments, the Bloomberg exclusive interview that you got from James Bullard today kind of confirmed that maybe it is actually on the Fed's radar. The market isn't that crazy. And I think that conversation is what's going to dominate the market, the stock market, the bond market for the next couple of days.
Yeah, no doubt about it. All right, kiddo, thank you so much. Really appreciate it. Bloomberg markets correspondent Creedy Gupta joining us on the phone. And just looking at the markets right now, still down about 85 on the S&P 500, down 1.9%, 1.5% lower on the Dow. NASDAQ down just about 2.2% here.
Yeah, just over 20 minutes until the close of markets. Let's head down to Washington, D.C. for a check of the latest world and national news with Nancy Lyons. Hey, Nance.
Thanks, Tim. The latest inflation report from the Labor Department points to a rate we've not seen since the 1980s. Consumer prices jumped 7.5% last month compared with last year, which is the highest jump since 1982. The inflation is hitting virtually every sector: groceries, electricity, cars, homes. Senator Joe Manchin of West Virginia says the numbers signal that something needs to happen fast.
The feds have to step up to the plate and do something. The administration has to do. We all have to work together right now to get our financial house in order. If not, it's going to be absolutely horrible what it's going to do to the American economy.
Manchin says now is not the time to pass the president's Build Back Better spending bill. Well, the Senate has approved a bill that would end forced arbitration at companies when sexual assault is alleged in the marketplace. Former Fox News host Gretchen Carlson has been working with lawmakers for 5 years to see this bill passed.
This is a historic day, not only for workers, but for our country. Both of our parties coming together to say enough is enough.
Carlson's lawsuit against former Fox News chairman Roger Ailes helped to launch the Me Too movement. President Biden and Senate Judiciary Committee Democrats are meeting at the White House this afternoon to talk about the upcoming Supreme Court vacancy. Biden is committed to getting advice on filling the vacancy from both Democrats and Republicans. Last week, he met with Senate Judiciary Committee Chairman Dick Durbin and Ranking Republican Chuck Grassley. President Biden has vowed to name a nominee by the end of this month. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
All right, Nance, thank you so much. Carol Master along with Tim Stanovic. We are Bloomberg Business Week, and this story definitely atop the most read. Kat Chiglinski and Hannah Levitt putting it out.
Warren Buffett's best performing stock last year. Well, Carol, it's one he's been dumping. You know what it is.
Yeah, Wells Fargo.
Yeah.
Yep. Shares delivering a total return of 61% last year, outpacing every other company listed in the most recent public snapshot of Berkshire Hathaway's portfolio. This was as of September 30th, and according to our data here at Bloomberg, that trounced the performance of the conglomerate's two biggest bets, Apple and Bank of America.
Buffett's Berkshire will give investors an updated look at its holdings in coming days. Already, though, its filings show that Wells Fargo's rebound was largely a missed opportunity. For years, the San Francisco-based bank ranked as the biggest equity bet by market value in Berkshire stock portfolio. It was routinely praised by the billionaire himself. But as the bank struggled to resolve scandals, Berkshire slashed its investment to roughly 670,000 shares by September. That from 323 million shares at the end of 2019.
And listen, last year, shares of Wells Fargo really taking off amid signs that Charlie Scharf, who took over in the last couple of years, I'm trying to remember exactly when. Really
Well, there's been a lot of turnover at the top there.
There has been, and he is an outsider that came in. He wasn't somebody who came up the ranks, making progress, though, in his efforts to turn the lender around. The CEO and his team clearing some key regulatory hurdles, and full-year profits soared more than tenfold after falling dramatically in 2020. Those regulatory hurdles were a big overhang on the stock, and I think prior to Charlie Scharf, there was some criticism that it was, constantly somebody who was leading the company that was internal and just not making the changes that needed to be made. But it's timing.
Yeah,
What?
it is. And, well,
And
this
he's
story
a
too.
long-term guy
I know.
usually,
So this story, Carol, just goes to show something that the legendary Oracle of Omaha talks about a lot. How difficult it is to do stock picking. And look, even he
Time
gets
the
it.
market.
He gets it wrong sometimes.
Right, exactly. I mean, most people would put out, though, his long-term investment returns.
Look at those.
And actually for some perspective. But it is interesting. We'd love to watch what he's doing in terms of where he's buying, where he's selling. So we're continuing to get updates on that. All right, check it out if you want to read the full story. It's on the Bloomberg Terminal.
headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Steep losses for U.S. stocks, lows of the day. But first, this headline, developing story. Zendesk, the software company, has been approached by private equity firms, including Thoma Bravo. This, according to Dow Jones. Zendesk shares surging now by 12.7%. Zendesk will be reporting earnings after the closing bell. Stocks at the lows of the day right now. 13 minutes to go with the S&P down 97. That is a drop of 2.1%. The Dow lower by 630 points now, a decline of 1.8%. Nasdaq is down 355, a drop there of 2.5%. 10-year yield 2.04%. Yield on the 10-year rising above 2% now at the highest since 2019. Stocks extended declines after Federal Reserve Bank of St. Louis President Jim Bullard said he supported raising rates by a full percentage point by July. We've got gold down 0.3 now, $18.27 the ounce. West Texas Intermediate crude oil up 0.3%, $89.91 a barrel. So again, repeating and recapping, 10-year yield 2.04%. The S&P 500 index now down by 100 points, a drop of 2.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
It certainly is. Thank you so much for that update, Charlie Pellet. It's 3:48 on Wall Street.
The following is an editorial from Bloomberg Opinion.
The Republican National Committee recently characterized the January 6th attack on the Capitol as an instance of legitimate political discourse. When asked for his opinion, Senate Minority Leader Mitch McConnell didn't mince words. He called January 6th a violent insurrection for the purpose of trying to prevent the peaceful transfer of power. By uttering that simple truth, McConnell performed an essential service to his party and the country. He seems to recognize the obvious, that attempting to rebrand a violent attack as legitimate discourse isn't a winning campaign strategy in 2022 and beyond. Republicans have hardly been profiles in courage when it comes to standing up to former President Donald Trump, but McConnell has consistently spoken out at key moments to protect the integrity of the democratic process. For that, he deserves the support of Republicans and the respect of Democrats. This editorial was written by the Bloomberg Opinion editorial board. I'm David Shipley. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPI and Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
And just about 10 minutes left in today's trading session, and we are, as you've heard from the updates from Charlie, we're pretty much at our lows of the session. Really concerns about a much more hawkish Fed, certainly on that hot CPI print. So let's get to it. Let's talk about the markets.
Yeah, really curious how Emily Hill, founding partner at Bowersock Capital, is feeling about this. Bowersock Capital has $800 million in assets under management. Emily Hill joins us on the phone from Lawrence, Kansas. Emily, how are you?
I'm doing well. How are you?
We're doing well. We're trying to make sense of what the Fed is going to do, why we keep getting these hotter than expected inflation prints. Even economists are underestimating how hot inflation is and when it will peak. Help us make sense of a day like today. How do you look at this in the context of what's going on in 2022?
Well, the inflation number was definitely disappointing, and it surpassed expectations. I think there was a hope out there that inflation was moderating, or at least that inflation was peaking, and the numbers today make it look like that is not the case. So the market is now pricing in, much higher likelihood of a 50 basis point increase in rates in March, which I don't think is a huge surprise. I do expect inflation to moderate over the next year, and I personally am not in the camp that's expecting 5 to 7 Fed rate hikes, but I think that's the possibility that the market is reacting to today.
Yeah, you're definitely seeing it play out. So how do you, first of all, I'm kind of fascinated by your firm. It looks like it's all women, which I think is pretty cool, if that's the case.
Yeah.
But I also like what you say about how you folks are grounded in the social sciences. And you highlight, the Rand Corporation, Yale University's International Security Studies, McKinsey and Company, Morgan Stanley. Just, it sounds like you guys are all coming from it at a different perspective. Having said that, then, when you look at a market like today's, what different conclusions maybe do you come to versus maybe what we're hearing from the pack?
Well, I'm so glad you asked that question because I'm actually passionate about having a different background from what is standard in this profession. And I spent a lot of time studying 20th century American history, and as I'm sure you have noticed, there are some major similarities today to what we saw in the post-World War II period. And, this pandemic has been very similar to a war. And if you look back there, and Paul Krugman has been arguing the same thing, the inflationary surge lasted close to 2 years. So we've had such a massive change in our society and our economy that I don't think it's surprising that we've had a surge in inflation. And so I think, I think that is leading to a panic, but it's really, there's a historical precedent for this that I think is reassuring.
Right, because you think about it, right? An economy that's all focused on the war ends, right? And then there's a real kind of recalibration, real shift. And it set off incredible growth in the economy and markets.
It did. It actually spurred a massive amount of innovation that occurred in the 10 years after the war. And we're seeing the same thing here, right? You have a boom in consumer demand. At the time, it was a reaction. It was the end of basically not being able to buy anything, not having anything available. So you had booming consumer demand. You had burgeoning public debt that was coupled with an increase in private savings. You had big labor market frictions. In that case, you had troops returning from war and having to get back in the labor force and rematched. The parallels are quite remarkable. And, obviously there were also some substantial differences. They didn't understand as much about how the international monetary system operated. They didn't inject kind of massive stimulus into the economy that we did this time around. But I definitely think there's some lessons that can be learned there.
Okay, so it all raises the question about asset allocation and where investors should be putting money right now. And of course, that obviously depends on time frame. But in general, a conversation that we've been having with asset managers has been, is there any place for fixed income in a portfolio right now? What are you telling clients?
I just had a conversation today with a client who I had a number of clients that have had large liquidity events in the last year and a half. And we had considered a very high quality, tax-free municipal bond ladder, about a year ago. And at that time, we were seeing about 50 basis points tax-free, right? Hardly worth doing. And also the concern that with interest rates as low as they are, is our principal even protected? Well, the same portfolio now is yielding about 1.35%. So I actually, and there's a huge demand for tax-free bonds. Now, I don't think you're going to make a lot of money. This is about principal preservation. But I do think, we will see in some of the very high-quality parts of the bond market, for high-net-worth investors at least, that want a portion of their portfolio to be oriented towards tax-free income and oriented towards preservation. There are better opportunities than there were a year ago.
Do you feel like we are settling down and finding levels in terms of a floor for the equity markets and maybe a ceiling for the treasury market?
I don't know about the ceiling on the treasury market, but we were saying around the end of the year that we expected about a 15 to 20% correction sometime during the first half. I think the market is going to continue to be volatile at least through the March Fed meeting and probably, through the end of the spring. And I think in some ways, we've seen the correction we expected, but I don't think it's over. So for clients of ours that have a lot of cash, our strategy, our approach is have a rigorous long-term asset allocation strategy and be putting cash to work now, but not all at once. Because their opportunities are continuing to unfold.
What's the timeline there, typically, in just 30 seconds?
Right now, for people with big liquidity events, it's 4 to 6 months reentry strategy or entry strategy, I should say.
All right, we got to run. Hey, Emily, great to check in with you. Emily Hill, she's founding partner at Bowersock Capital, $800 million in assets under management, joining us on the phone from Lawrence, Kansas. And that is where the firm is based. All right, just a few minutes left in today's trading session. Quick check on the trade. S&P 500 down just about 82 points, a decline of 1.8%. Dow Jones Industrial Average, we're looking at a loss of about 1.5%, down 527 points. As for the NASDAQ, it's the underperformer, down about 2%, a decline of 300 points. We're going to count you down to the closing bell and take a look at some of the stocks on the move. This is Bloomberg Business Week, and you are listening to Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. 90 seconds to go ahead of the closing bell. The Dow, the S&P, NASDAQ, all lower. S&P lower now by 80 points, down 1.7%. The Dow tumbling 503 points, down 1.4%. NASDAQ down 292, a drop there of 2%. We've got stocks very close to session lows. Yield on the 10-year Treasury rising above 2%, highest since 2019. 10-year yield right now 2.05%. Stocks extended declines after Federal Reserve Bank of St. Louis President Jim Bullard said he supported raising rates by a full percentage point by July. Bullard's comments followed data showing inflation accelerated to a 4-decade high in January, with the consumer price index reaching 7.5%, more than the median estimate of 7.3% in a Bloomberg survey. Emily Hill is founding partner at Bowersock Capital Partners. She was our guest moments ago right here on Bloomberg Business Week, and she reacted to today's hotter-than-expected CPI report.
I think there was a hope out there that inflation was moderating, or at least that inflation was peaking, and the numbers today make it look like that is not the case. So the market is now pricing in, much higher likelihood of a 50 basis point increase in rates in March, which I don't think is a huge surprise.
And again, as we head toward the closing bell, 10-year yield 2.05%, down day with the closing bell at the New York Stock Exchange. S&P down 82 points, down 1.8%. Dow Industrials down 534, drop there of 1.5%. NASDAQ down 304, a decline there of 2.1%. CPI wasn't the only report today. We got data showing America's labor market is making progress in the aftermath of the Omicron surge. And with that story, here's Bloomberg's Vinny Del Giudice.
Jobless claims retreated for a third week, dropping to 223,000. They hit a half-century low in December, just before the latest and perhaps last COVID-19 surge. Businesses are competing to fill record job openings, due in part to changing demographics and post-pandemic work habits. Vinny Del Giudice, Bloomberg Radio.
After earnings, the Walt Disney Company up today by 3.4%, PepsiCo down 2.1%, Coca-Cola higher by 0.5%. We're also awaiting the latest numbers out of Expedia and Zillow. Recapping, stocks lower with the S&P down 83 points, a drop today of 1.81%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Nobody move a muscle. Bloomberg Business Week. Movers and shakers.
Damn, Stippy, you got to move.
On Bloomberg Radio.
Yes, indeed, everyone. Charlie giving those closing numbers. Rough day for the equity markets. That doesn't mean there weren't some stocks that were outperforming. And Tim, I was just kind of looking through my list of names. I mean, Disney was up 3.6%. Mattel, we talked to the CEO, up 7.6%. They are seeing ways of managing the supply chain and growing their key markets. Twilio, we saw really rallying in a big way. Datadog, number one in the NASDAQ 100.
That was
up
one of your
12%.
gainers a few days ago.
Well, it's kind of popping up on my radar. Number one in the NASDAQ 100 cloud software company, strong results and a forecast. Sonos, we're going to check in with the CEO of Sonos. It was up 4.5% post-earnings.
Well, let's check in now with Abigail Doolittle, who's joining us now to give us her reaction to the markets today. Abigail, we can't talk about what happened today without talking, of course, about that print at 8:30 a.m., which really changed everything in terms of how investors were thinking about inflation, thinking about the Fed. What is your takeaway when you are thinking up your note that you do each and every day, which I'm so grateful for, that you sent to the Bloomberg newsroom to give us a deep dive into what happened during the day?
Oh, that's very kind, Tim. And wow, what a day. It's really incredible. It's hard to know where to start, stocks or bonds. I would say in the case of both, 1% by July was not priced in. I think that's one thing that we now know. But I think that's what's really catching my eye. The 2-year yield, it has backed up 26 basis points in a single day. Last year, it backed up 60 basis points, which was extraordinary, but you'll have almost half of that in a single day. So that really tells you that markets are doing the Fed's work. They are taking the likelihood of 0.5% higher in March, a hike, pretty seriously, and perhaps even that 1% in July. If you take a look at the yield, it spiked on that hot CPI print coming in at 7.5%, higher than the 7.2% expected. And then another spike on those Bullard comments, really supporting the idea that the Fed could get pretty serious here. And on that, you see a repricing of risk with stocks. So stocks before today, probably not thinking that there was definitely going to be 0.5%, and certainly not thinking that there was going to be 1% hike likely before July. We still don't know that, but that's just the Fed talk today that's driving markets, it seems.
Well, and it's knee-jerk reaction to some extent. And I do think about how over the last couple of weeks, Abigail, we had a point where we thought the Fed, I think was it coming off the meeting, was a lot more aggressive. And then you had some Fed members come out and talk it back down. And now it's kind of getting talked up again.
Well, it's interesting. This is how the Fed works, or at least to my interpretation of it. And it's very artful. And it's one reason that I think that generally, it's easy to criticize the Fed now, but typically in hindsight, at least my experience in hindsight, the Fed was doing what markets and what the economy needed, and always seems to get out of jam after jam as the markets meet the Fed and the Fed meets the markets, and it's by that jawboning up and down, and so it'll be interesting to see. I haven't looked at the FOMC calendar. I should actually do that, or interviews. But will we have any Fed officials talking back Bullard's comments tomorrow or early next week, and kind of have that movement up and down? But ultimately, it does seem as though the Fed will be certainly hiking many times this year. And if they don't at this point, with yields backing up so much, it would create a problem. They're definitely, I think the markets are forcing them.
But Abigail, we knew the Fed was going to be probably hiking rates multiple times. We thought that they would be in quarter-point increments. But this isn't news, right? It's just now it feels like it's a little bit more urgent, aggressive, a little bit more hostile, if you will.
Yes. Well, it's interesting because I think, was it last week or the week before? It's hard to know. The weeks and days this year are really blurring together. But that one day where the headline was anywhere between 3 hikes to 7 hikes this year from the big Wall Street banks. And it was hard to even hear that and not, scratch my head. But here we are. It seems very likely that there will be 4 by July, which makes it very easy potentially for 7 by the end of the year. And so I think the difference here, that hostility that you're talking about, traders are now believing the Fed is for real. But again, the Fed is going to have to act. In a way, with yields up so much, there's almost a game of chicken, but it seems as though the Fed will have to act.
What I've been thinking a lot about this week and last week, Abigail, is what we hear from on the macro level from the Fed and what we hear from analysts when they're thinking about inflation and rate hikes, at the same time that we're hearing from companies in the midst of earnings season, companies like Disney having blowout quarters with parks here in the U.S. Doing better than they were doing a couple of years ago. Streaming subscribers, blowing way past expectations. Great earnings from Sonos, Mattel. The list goes on, and they haven't all been good. But let's keep that in mind. So how do you reconcile that with what we see in the macro environment and what we see in terms of the way that indices are moving with what we see in individual stocks and hear from companies about how things are pretty good right now?
Well, that's a great question, or a great set of questions. And one thing that is becoming clear to me right now, it feels as though it's shaping up as a stock pickers market, maybe a sector pickers market, but more so a stock pickers market. Because, for instance, today, both Pepsi and Coca-Cola reported, and I actually need to see where these stocks close before I say this, but Pepsi, they reported a great quarter relative to sales and volume and demand, but margins got hit. Yeah, down 2%. Coca-Cola, that stock is up 0.6%, and they reported a great quarter, and margins are okay. So it shows you that these companies are managing margins a little bit differently. So I think that you're seeing a lot of divergences there too, and also seems consumers are willing to stand by, say, their Chipotle's, their Harley Davidsons, and then other areas maybe a little bit less so. So I think that's some degree of what we're seeing right now in terms of these different reactions.
Some of it feels like too, how we're managed in terms of expectations for individual companies,
I agree
right?
with you on that. Management of expectations and perception is everything.
Hey, you look at the S&P 500, the major industry groups, year to date, it's still energy by a wide margin. Everything else, for the most part, is down. Financial's also doing well, but it's a reminder that many sectors have corrected here, or at least taken a beating.
It's a reminder of that, Carol, and it's also a reminder of something else that Steve Sosnick of Interactive Brokers and I were chatting on the phone the other day, and he was taught in the 80s, not to date him, but in the 80s when he started out in the business, he was taught that when energy leads, that's the sign of a potentially difficult market ahead. So that could be an issue, especially given the fact that energy was up nearly 50% last year. And then, Tim, going back to your question about, the economy, it's interesting. I was just interviewing Christian Fromhertz of Tribeca Trade Group on Options Insight, and he was saying that he's not scared by this inflation because if you take a look at copper, it's outperforming gold. So that suggests that the economy is doing okay. But so you have all these different views and companies reporting different results, although overall strong to your point. And I think that that's a lot of why we have these volatile whipsaws and trading ranges. And we have a trading range in the S&P 500 and many of the indexes over the last, let's call it 3 to 6 months, and for some of them even much longer than that. And the Russell 2000 breaking below its trading range of last year. That is all about uncertainty. So there's uncertainty, two sides make a market, and we're certainly seeing that.
Right, and I feel like the swing of opinions, right, as you mentioned,
definitely.
That it's just a reminder that right now this is a difficult market and economic environment to call, and certainly I think a tough fit, right?
Yes, one trader who I respect very much, I saw this on Twitter of probably about a week or two ago, and he was saying, because there's this idea, people think, a trading range, that's what traders want, but it's very, very difficult to get it right, and he was saying that this is one of the most difficult careers in his 20-plus career. So I think it's just hard to get it right, especially because of the intraday volatility, up, down, and now we have a big down day.
Strap yourself in, and it's only February. All right, Bloomberg News Markets reporter Abigail Doolittle, thank you so much. Great analysis.
Well, let's head to Washington, D.C. for a check of the latest world and national news with Nancy Lyons. Hey, Nance.
Thanks, Tim. With today's inflation rate showing prices rising 7.5% year over year in January, President Biden is honing in on prescription drug prices. He says Americans are paying too much.
We pay the highest prescription drug prices of any developed nation in the world.
During his stop in Virginia, Biden also vowed to, quote, work like the devil to bring gas prices down. Russia and Belarus have begun their largest joint military exercise in years, with the U.S. and Europe closely watching.
Thousands of troops are engaging in Allied Resolve 2022, including maneuvers near the borders of Ukraine, Poland, and Lithuania. The U.S. and NATO allies are worried that the drills are preparation for an invasion of Ukraine, including through Belarus from the north. Troops will use 5 military training areas to practice what Russia describes as the suppression of and defense against external aggression. Moscow has repeatedly denied it plans an attack on Ukraine. In Washington, I'm Amy Morris, Bloomberg Radio.
The House committee investigating the Capitol riot now says there are gaps in official White House phone logs for January 6th. The New York Times is reporting while investigators have not found evidence official records were tampered with or deleted, they do know the president was making phone calls during the attack. The committee has subpoenaed Trump's personal cell phone records from phone companies. Royal officials say Britain's Prince Charles has tested positive for COVID-19 and is self-isolating. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nancy, thank you so much for that world and national news update. Carol Massar, Tim Stenovic, we are Bloomberg Business Week out in our LA bureau. And here's a company that's based on the West Coast.
Yeah, Meta Platforms we're talking about. This is interesting because, when we were talking with Romaine a few days ago, Carol, about Facebook's 4-day in a row decline, I still call it Facebook. Meta Platforms, excuse me.
It's like
hey,
Google
the ticker's still FB, okay?
Yeah, it's going to change, though.
It is going to change, yeah, thanks to that purchase from Roundhill. Roundhill
I wonder what they paid for that.
I do,
we
too.
know?
We don't know.
You know it was a lot.
Yeah, but everyone wants to know.
Because
Will
they're like-
Hershey runs Roundhill, and he's the guy who we need to.
Yeah.
Well, I'm sure he is not going to say, but
Right?
we
It's
need to know.
It's like, how much do you want?
You had to know Facebook wanted that so badly, right? You know they have the
they
cash
did.
to pay.
Remember when people early were like buying up
Domain names? Yeah.
names? Anyway, okay, we digress.
We do, but we were talking about the historic decline that we saw of post-earnings for Facebook last week, and Romaine reminded us that back a few years ago in the wake of the Cambridge Analytica scandal, we saw a drawdown that actually exceeded, not in one single day, but over a few days, that actually exceeded the drawdown that we saw last week in Facebook stock.
All right, well, with that in mind, there's a story on the Bloomberg about Meta Platforms. Facebook must share any documents related to work for Donald Trump's 2016 U.S. presidential campaign. It's part of a consumer privacy lawsuit over a data harvesting scandal involving political consultancy, Cambridge Analytica. That was like in the news all the time.
It was.
We really thought maybe it had gone away, but apparently not.
Well, Facebook had tried to challenge consumers' bid for the documents, but failed to dodge the request, according to a Wednesday order denying reconsideration by a court-appointed referee in the U.S. District Court for the Northern District of California.
Right. Lawyers for the case, the consumers in the case specifically, arguing that the documents could shed some light on what information was harvested from Facebook users and how political and other advertisers could use it. We know social media influential like never before, and especially in politics. So understanding the dynamics, you can see why this case is probably moving ahead. All right, you're listening to Bloomberg.
24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Tape. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Lots of earnings after the bell. We begin with Zillow Group, shares up now by about 7%. Zillow posted better than expected results for the fourth quarter as the hot housing market helped speed the company's bid to wind down its home flipping business. Expedia shares up more than 4% in post-market trading after the online travel agency reported adjusted fourth quarter earnings that beat expectations. Urban Outfitters saying fourth quarter comparable retail segment sales were up by 14%. A brutal day for the bulls today with the Dow, the S&P, and NASDAQ all declining. Stocks sank. Treasury yields spiked higher after the hottest inflation reading in 4 decades prompted a Federal Reserve official to call for accelerating rate hikes. S&P down 83, a drop of 1.8%. Dow Industrials down 526, a drop of 1.5%. NASDAQ down 304, a drop of 2.1%. The NASDAQ 100 index down 2.3%. Equities did close near session lows. 10-year yield 2.05%, 2.05% on the 10-year, highest since 2019. Spot gold down $6, now $18.26 the ounce, down 0.4. West Texas Intermediate crude up 0.5%, $90.06 a barrel. Recapping a sell-off today with the S&P falling 83 points, down 1.8%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, appreciate that update. Want to talk a little bit about Sonos. The stock up about 4.5% in today's session. This after the latest quarterly update. We were breaking it down yesterday after the close. Adjusted EPS revenue beating estimates. The company's showing it had an ability to overcome those supply constraints, growing holiday sales. So investors definitely liking what they had to say.
Well, let's talk to Patrick Spence, CEO of Sonos, all about it. He joins us on the phone from Santa Barbara, California, just about 80 miles north of where we are here in Los Angeles. Patrick, how are you?
I'm good, Tim. How are you?
We're doing really well, thanks. Hey, last time we spoke to you, about a quarter ago, you were confident, but I think it's fair to describe you as a little nervous about the holiday quarter and making sure that you had enough supply to meet demand for the holiday shopping season. Here we are a few months later. Did you have enough supply to meet demand?
We did not. You know, we successfully navigated probably the most challenging supply chain conditions I've ever seen in my career, and we got more out to our customers than we had planned and exceeded expectations, but there was so much demand that we couldn't fill, and we've, continued in January and February to continue to try and fulfill that demand for our customers. And you nailed it, Tim. I mean, going into the quarter, we knew it was going to be a tough one. We had provided that color to everybody, and I am so proud of the team's effort because we really navigated it well considering all of the challenges that we had, and we did better than expectations. So feel good about that, but also feel good about putting that quarter behind us.
Right. I think a lot of people feel good about putting 2021 behind us.
Is it really behind us,
Yeah.
Patrick? Is it really behind us? Are there signs that you're seeing that it's getting better?
Yeah. Oh, absolutely, Carol. So, I definitely feel like it was the low point, again, for us. And there's a variety of different components, and, every situation is a little different in terms of every company you'll hear from. I saw Foxconn today as well, kind of giving a similar perspective, which is we're by no means out of the woods, but that for us felt like, the tightest period. And, we stay very close with, we both have the demand signals from our customers, obviously with a big direct-to-consumer business and all of our great channel partners, but we as well see our products lighting up every single day. So we have a really good handle on consumer demand. That remains very strong for our customer base. And then on the flip side, we're working very closely with our supply chain partners to make sure that we can deliver on this. And it's not like we will have everything sorted out in this quarter, but it definitely gets better through the year, and that's why we felt confident in raising the midpoint of our guidance.
How do you quantify the opportunity lost in the most recent quarter to people going to the website or going to a store and seeing that Sonos wasn't in stock, and instead of buying that Sonos speaker for somebody for a gift, they went and bought something else for that person versus somebody buying for themselves, maybe waiting a few weeks and saying, okay, I can buy this for myself in January or February. How do you quantify that?
So a couple of things. One is we're such a considered purchase, right? And, and it really goes to our model. Our existing customers are our number one generator of new customers. And so they're telling their friends and family how much they love it, and they understand that there's nothing quite like it. And then from more of a tactical mechanics perspective, we watch very closely the orders from our direct-to-consumer business, and people have been willing to wait, Tim. Like, they've been willing to wait, 8, 10 weeks for product at times, and we watch it whether people cancel or not, and going through that, and we also look at and we triangulate that with third-party market share reports to understand how we're doing. And since this has been a lot of industry-wide, supply chain challenges, I feel like we're coming out of this and we've navigated it better than anyone in our industry, that's for sure. And we're in a strong position, and we'll continue to work hard at delivering to all those customers that have been waiting, and try and get back in a situation where you don't have to wait that long.
Patrick, how big is the backlog?
That it changes every single day in terms of what's there, but it's significant in terms of what we're working through. I certainly hope that by the end of our fiscal 2022, we're through it all. But we said a couple things. One, there's the back orders that we have today, and then we don't have our channels filled, back up to where they need to be. So, you might walk into a Best Buy or a Costco and not be able to, buy a Sonos right in that particular moment. So we've work to do to get those channels restocked, and then we have work to do to deliver back to our customers as well. So it's significant.
Hey, Patrick, Carol and I have talked about this a lot on air, but we both have Sonos systems at home, and we do like them, full disclosure. But how do you get recurring revenue from people like us? Because we don't necessarily need any new speakers.
Of course you need new speakers, Tim. Over time. I am sure there's a room that you haven't added it to. But look, going back to kind of really
sound like my husband. You could always have more speakers.
Yeah. Back to, it really goes back to our business model, and we're not a one and done kind of purchase, whereas, some products are. And so, you saw last year, about 45% of our sales came from existing customers coming back and adding another product. And we also shared that the average number of products per customer moved up to 3. And we think that can go over time to 4 to 6, right, as well. And so we actually have an annuity. We've been shipping products since 2005. They were part of that cohort that actually came back and bought products last year. So this.
Yeah, Patrick, hang on for a second. We're going to come back and continue with Patrick Spence, CEO at Sonos, on the phone from Santa Barbara, California. We'll be back with him in just a moment.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
You are listening to Bloomberg Business Week. When we come back, we're going to continue with Patrick Spence. He's the CEO of Sonos. Talk a bit more about, we've been talking about the business, but I want to also, talk about future growth, where they're going in terms of innovation.
How are they thinking about interest rates too?
And people, right, if they're not going to maybe be buying houses as much.
Exactly. All right, first, though, let's get a check of what's going on when it comes to business news. Here's an update from Charlie Pellet.
Thank you very much. Lots of earnings after the bell. Big moves. Got to begin with Zillow Group. After hours, that stock up by 17%. Zillow Group posting better than expected results for the fourth quarter as the hot housing market helps speed the company's bid to wind down its home flipping business. Zillow after hours again up by 17%. Expedia Group reported fourth quarter profit that topped analyst estimates, benefiting from a holiday travel season that proved resilient despite the onset of the COVID-19 variant. Shares of Expedia after hours up now by 4.5%. A down day, and that is putting it mildly. Stocks sank, Treasury yields spiked higher after the hottest inflation reading in 4 decades prompted a Federal Reserve official to call for accelerating rate hikes. St. Louis Fed Chair Jim Bullard said the central bank should raise rates by 100 basis points over the next 3 meetings. That sent risk assets tumbling. Mike Wilson is chief U.S. equity strategist at Morgan Stanley.
All that really means is that the Fed is not going to be going more dovish. And I think the equity markets in the last few days have been kind of hoping that the Fed, maybe isn't going to go as quick as they were fearing a few weeks ago. And this pretty much throws cold water on that. But that's been our view all along. I mean, with whether inflation's 7.3 or 7.5%, I mean, they're going to go and they're going to go hard.
Mike Wilson of Morgan Stanley talking about today's inflation print. S&P end of the day lower by 83 points, down 1.8%. The Dow dropped 526, down 1.5%. NASDAQ down 304, a drop there of 2.1%. Stocks closing at or near session lows. 10-year yield 2.03%. Spot gold today down 0.4%, 18.26 the ounce. Bitcoin down 0.7%, 44,200 on Bitcoin. West Texas Intermediate crude up 0.3%, 89.93 a barrel. So again, recapping, we've got the 10-year yield 2.04% right now. S&P down 83, down 1.8%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. I want to get right back to Patrick Spence, CEO at Sonos, joining us on the phone again from Santa Barbara. Patrick, we talk a lot about housing on the show, and I would imagine that new housing and household formation and people moving over the last couple of years to bigger homes during the pandemic really helped out sales of Sonos speakers. Today, we saw that U.S. mortgage rates jumped to 3.69%, the highest since January of 2020. That is, of course, pre-pandemic. I'm wondering how you're thinking about or planning for a potential slowdown in real estate as home prices get more expensive and mortgage rates continue to climb.
I think we've kind of looked at the data, 8 different ways from Sunday to look at any macro trends and how it impacts our sales and how it has over the last 17 years. And there's not really, we haven't seen kind of like a macro factor that we have a correlation to. And I think what I chalk it up to, quite frankly, is that we're still pretty small in the grand scheme of things, right? We'll do $2 billion this year in revenue in a market that the global audio market's about $89 billion. And we're maybe in about 10% of the homes that we think we address in the more affluent home sector. And so, adding some Sonos at, everything's under $1,000, in terms of what our set is, goes from 200 to about 800 to 900. I think it are things that we've seen continue to sell in prior, macro weak conditions, and we see in strong conditions as well. And all of those new customers we added during the last couple of years, if history serves, they'll continue to add products over, the next couple of years, no matter what happens. So we're optimistic.
Hey, you go to your website, you see the array of products, but you also, have Sonos Radio and content. We're getting ready to do the Power Player Summit tomorrow and talking to a lot of team owners, folks that are making investments in all kinds of businesses that play into the world of sports. I'm going to talk with Stephanie McMahon over WWE, person who's key in terms of sports for Amazon. They all talk about content. How important is that as you think about how you continue to build out the Sonos array of products?
We want to be the one that can serve up all that content in a way that's really easy for customers to access. And so we give, that's our differentiator, right, is really being open to every music service, every voice service, every radio service that's out there. And so our goal is to make it really easy and really accessible so that people can quickly find, what they want to listen to. And so that's where we're going to stay focused and really ride the wave of all that amazing content, not only on audio, quite frankly, but as well on video, right, with our soundbars. So we benefit from, Netflix putting $20 billion into content and Disney putting $33 billion into content. So all of that is key, and those investments are important tailwinds to our business.
That's what I was going to say. Moves the needle for you guys, Patrick?
Absolutely. One of the big macro trends is what we call Hollywood at home, right? So all of this viewing of all this great content that's coming into our living rooms, and you want to hear that the way you would hear it at a theater. And so that's what we do when it comes to your living room.
Hey, I want to talk product development here and try to understanding the product pipeline as you think, not just in the next couple of years, but 5-10 years from now. What do Sonos speakers look like in the next decade?
It's not just speakers, right? And so as we think about where we play, obviously we have the IKEA partnership. We have an Audi partnership, so we're starting to show up in cars, and that just got a great review from one of the definitive audio reviewers. So I would say, like, for us, and my goal is that we're the sound experience provider in all aspects of your life. And, we've started over the course of the pandemic, we've started to go outside the home with 2 new products, Roam and Move. So, we're expanding beyond, and we have a lot of room in that whole $89 billion global audio market. So you'll see a lot more products from Sonos, upping the game in existing categories, but as well going into new categories for sure.
Well, always great to check in with you and hear what's going on. And as we said, both Tim and I, full transparency, are users, but really great to hear what's going on. Patrick, thank you so much. Be well, stay safe. Patrick Spence, he's the CEO of Sonos. They did come out with their latest quarterly update. We were talking about the numbers last night, showing good demand, ability to navigate supply. These are what analysts are saying post their results.
It's funny, I think back to my first experience understanding the supply chain constraints as a consumer was when I went to buy that Sonos Move speaker for my dad. I think it was for Father's Day, for his birthday. But that was the new product that I bought last year, bought it online, and then saw when I was checking out, it was like, 8 to 12 weeks away for shipping or something like that. And I was thinking, what is going on here? And that was my first foray into the supply chain pain.
That's really interesting. We got ours during the pandemic, like early on, because we were spending time outside, and we were lucky, I think, just got it ahead of that. All right, let's get back to world and national news. Nancy Lyons in our D.C. studio. Hey, Nance.
Hey, Carol. With renewed concerns about inflation, President Biden took his pitch for lowering drug prices to Virginia today. He wants Medicare to be able to negotiate drug prices.
The president spoke as the inflation report showed a year-over-year increase of 7.5%.
I'm going to work like the devil to bring gas prices down. I know food prices are up, and I understand. You still have to pay your prescription drug prices. You still have to pay for health care. You want to lower the cost of living for people, help them in those areas.
The president was also campaigning for Representative Abigail Spanberger, who is stressing the prescription drug issue as opposed to the ambitious Biden economic agenda. In Washington, Irv Chapman, Bloomberg Radio.
The House panel looking into the Capitol insurrection are finding more missing documents. Those close to the probe say the White House call logs that the panel has obtained do not list any phone calls made by then-President Donald Trump as he watched the violence unfold on TV. This is despite others confirming numerous calls were made. The National Archives has also asked the Justice Department to look into whether there are any classified documents that were recently retrieved from Trump's Mar-a-Lago estate. Thousands of New York City employees are expected to be fired tomorrow for refusing to comply with the city's coronavirus vaccine mandate. Mayor Eric Adams says it's up to them.
If you hire and you get this job, you have to be vaccinated. If you are not following the rules, you are making that decision.
Termination letters have gone out to about 4,000 workers, including teachers, officers, and firefighters. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
All right, Nance, thank you so much. Carol Master, Tim Stanovic, and, top
Are you going to start
musicians.
singing?
I was trying to think of a good song. Police?
Yeah.
Which way do we go?
I don't know, but we've talked a lot about artists selling their catalog. Sting is the latest to sell a career of catalog songs in the latest music rights acquisition.
Yeah, Universal, not disclosing the deal's value, said it marks, quote, one of the most significant catalog acquisitions in music history. Company, you might recall, bought Bob Dylan's entire song catalog. That was in 2020. That pact was worth more than $300 million. Who gets that? The music label?
Oh, it's so complicated.
Right?
Fortunately, we're in LA where Lucas Shaw works, so we can go ask him when we're done with this because he has the skinny on the complex rights management when it comes to this stuff. We're talking about Sting, the co-founder, frontman, and bassist of The Police. Sold more than 100 million albums throughout his career. The artist was represented in the transaction by Alan Grubman with his partners Joe Brenner and Stuart Prager. Hey, Carol, I'm also reminded of Sting because the Hulu series Only Murders in the Building with Steve Martin and Martin Short has some great cameos from Sting. And it's fantastic.
Okay.
Highly recommend it. But you don't take my advice for when it comes to watching stuff anyway, because I've given you some bad.
Power of the Dog. I know, it got lots of nominations. It's so funny driving around LA, like just to come here.
Yeah, I noticed that.
They're plastered everywhere. And I'm like, all right, Tim must have been onto something.
Yeah, led Oscar nominations, but you guys weren't big fans.
I did watch the entire thing, though.
Thank you.
UMG has been the Sting's record label for his entire career, and it includes stuff he did solo as well as with The Police. Deal unites the British-born singer's song catalog with his recorded music catalog under Universal. I do wonder what the price tag is.
Well, he's still working. He's on tour. He's going to resume his My Songs World Tour next month, followed by his Las Vegas residency. That's at the Coliseum at Caesar's Palace. That's happening in just a few months, June of 2022.
Free, let them.
Okay, yeah.
The song?
I'll take
I don't know. I can't know. I'm just giving up. All right, you're listening to Bloomberg Business Week, and this is Bloomberg Radio.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We continue to keep an eye on Zillow shares after hours, surging now by 18.5%. Zillow posted better than expected results for the fourth quarter as the hot housing market helped speed the company's bid to wind down its home flipping business. Again, Zillow after hours up now by 18.5%. Expedia Group reported fourth quarter profit that topped estimates, benefiting from a holiday travel season that proved resilient despite the onset of the Omicron COVID-19 variant. After hours, Expedia up now by 5.1%. Zendesk says it is rejecting an unsolicited, non-binding all-cash acquisition proposal from a consortium of private equity firms valued at between $127 and $132 a share. Stocks sank. Treasury yields spiked higher after the hottest inflation reading in 4 decades prompted a Federal Reserve official to call for accelerating rate hikes. S&P down 83, a drop of 1.8%. The Dow down 526, down 1.5%. NASDAQ down 304, a drop of 2.1%. 10-year yield 2.03%. Gold down 0.3, $18.27 the ounce. West Texas Intermediate crude oil up 0.4%, $90.03 a barrel. I'm Charlie Pellet. That's a Bloomberg Business Flash.
All right, Charlie, appreciate that update on what's been another interesting market day. Well, it's a new year, new opportunities, new challenges. As certainly Charlie was just laying out. Our next guest, though, understands all of that when it comes to the investment environment. He has been involved in the development of many technology companies, including the funding of 55, 18 of which, though, also ended up IPOing.
We're talking David Sprang, the founder and CEO of Runway Growth Capital. He joins us on the phone from Silicon Valley. David, great to chat with you again. How are you?
Hey, Carol. Great to speak with you guys.
Hi.
Yeah, really great to chat with you again. Venture capital debt. Before we get into how it's doing right now, explain what it is and how it's different from a company going out and raising traditional VC funds.
Yeah, absolutely. So venture debt is a complement and sometimes an alternative to venture equity, and particularly for late stage companies as they grow and become more mature and have more confidence in their business, it's appropriate to use a combination of debt and equity. And so venture debt will very often be used by venture-backed companies to extend their runway, hence the reason that we named our business Runway, so that they can achieve more milestones before they have to raise additional equity. And at the end of the day, it results in the founders, management, and early investors owning more of the company by giving up less to later stage equity investors.
Well, David, it's a great primer, right, when it comes to debt equity. Like you think about liquidity events, and when you get into debt, it's a way of founders, right, really retaining their ownership of a company and not giving up more equity, but also being able to access capital to grow the business or do whatever.
Very well said. You should be our spokesperson, Carol.
Just doing this a long time. No, it's fascinating, having done some things on liquidity events, and you realize there's just multiple ways. I mean, a company can be sold, it can be, there's just lots of different ways to do it. Having said that, then what's the investment play, especially as we increasingly, David, talk about alternative ways for investors to find returns in what's a really tricky environment?
Yeah, it's true. And more investors, whether they be retail, high net worth individuals, or institutional investors, are looking into the world of alternatives, particularly folks that are seeking yield. And there's been a lot of discussion today about interest rates and how low they are and how they may be, and very likely almost certainly will be moving up, but they're still very low. And so for investors that are looking for yield, the venture debt world has been a really good spot because the returns are, in the double digits. They pay on a current basis, and the losses are extremely low. There are 5 publicly traded venture debt funds. Ours is one of them, but there's 4 others. And, it's a great alternative for investors that are looking for some exposure to Silicon Valley, but also want to benefit from a high current return and low volatility. Because at the end of the day, these are pretty much yield-oriented products, but we do get warrants in almost every company in which we invest or to whom we lend money, and those warrants can sometimes add a really nice upside.
Well, Runway Growth Finance Corp went public last year, and I'm wondering, David, how it has been in the public markets right now, and why you made the decision to go public with a company like this.
Yeah, so when we started the company in 2015 and first raised money in 2016, we did it in the form of a BDC or a business development company, and we were a public filer, so registered with the SEC, reporting with the SEC, but not publicly traded. So we've been practicing to be a public company for almost 5 years. And the reason for going public was primarily to offer liquidity to our early investors. There are plenty of BDCs from name brands that household names like KKR and Apollo and Carlyle and Goldman Sachs, and they have both public and private BDCs. And some BDCs do decide to stay public for a long time. For us, we wanted to be able to offer our investors the chance to get liquidity when they want to. And so becoming a public vehicle just made sense. And it was the path that we had promised people we would take. Right. And the market was very receptive, and we were fortunate enough to attract, world-class underwriters like JP Morgan, Morgan Stanley, Wells Fargo, and UBS to lead the deal for us.
Hey, David, what's been the connection between venture debt, the demand for it, and what's been going on with SPACs, which, as we know, were kind of high flyers early last year and then just down from there? But what's the connection? What's the connection between demand, as I said, for venture debt specifically, and what's going on with the SPAC activity?
Yeah, so the demand for debt is going to remain very high and probably will increase in 2022. The decline in value of the comparable companies, will have a delayed impact. The private markets always follow the public markets. And so, our view is that in 2022, even in a rising rate environment, debt is going to remain cheaper than equity, and that difference will even be magnified, so that equity is getting more expensive is the bottom line, and that debt remains cheaper than equity. And so borrowers, venture-backed borrowers, particularly late-stage companies, that might have been attracted to, high-valued equity, are now going to be even more interested in debt. And there's a few other factors that lead to the really positive environment and strong tailwinds for venture debt. And one of those is that we're seeing a lot of late-stage companies choosing not to take overvalued equity. Now, that sounds kind of crazy, right? So, if SoftBank or Coatue or Tiger comes to you and wants to invest in your company at a really high value, it's tempting. But with that equity investment in the billions comes the
pressure,
expectation,
right?
Yeah, it's a lot of pressure that you're going to create multiples of that for them. And that may not be consistent with what the management team or the founders or the early investors want to do. So we're funding right now a couple companies, one in particular that turned down a term sheet from one of the names I mentioned because they didn't want the bar to move up so high that they would have to keep building the company for another 5 years.
Investments with strings. Right?
Yes,
ultimately.
That is right. It comes with strings. Yep.
Well, David, fun to check in with you. It's another part of our investment world, and it's a growing one. There was a great piece on the Bloomberg last year just talking about the growth of this market. David Sprang, founder and chief executive officer at Runway Growth Capital, on the phone in Silicon Valley. Tomorrow, cool
Power
stuff.
Players Summit, Carol. We have a busy day ahead of us from Beverly Hills. It's going to be a great one.
Eric Dickerson, Carly Lloyd, you name it, the CEO at Zero Gravity. Great guests join us.